Okay, welcome to the February 14th edition of the Fats, Fuels, and Oils webinar. Happy Valentine's Day, everybody. This week, we're going to do a quick review of last week's WASDE report and then talk a little bit about expectations for what's going on in biofuel production with the EMTS data that's coming out next or this Thursday rather. So let's get into it. All right. So generally, USDA didn't make huge changes or unexpected changes to their new crop U.S. soybean oil balance sheets. They cut their crush by 10 million bushels. That left it just below ours. I think they're at 2.225 and we're at 2.223. So just 5 million bushels difference. But that reduced their production by 65 million pounds, and they more than offset that with a cut in their export forecast to 700 million pounds, which is still 200 million pounds above ours. On the exports, you know, we have gotten off to an historically slow start to the export season. And for a long time, I thought that there probably would be pickup at some point, especially as concerns about Argentina grew, but that doesn't seem to have happened, at least in the export sales data yet. And so I cut mine down to 500. That's a number that I think is about half of what I thought sort of the lowest level that we would go on exports is, but it's something that you see in most of the feedstock markets. So if you look at tallow exports or choice weight grease exports, a lot of those have also fallen off pretty dramatically this year. And it's not surprising. I think it's something that everybody expected to happen. And I think everybody expected it to happen last year and to some degree, maybe even the year before. But here it finally is. The US is going to be out of the export market effectively, which shifts a lot of the opportunities to South America. And with the Argentine crop down, USDA cut their forecast to 41 million tons, which is just a little bit above where we are. That kind of leaves Brazil as maybe the country that benefits the most from the decline in US exports, which is not something that I think would happen in a normal year if Argentine production was normal, and it's not something that I probably expect will continue. Now, fortunately, it sounds like Brazil's crop is everything that we expected it to be and more based on recent reports. So we've taken our forecast for Brazil up to like 156 million tons, and that's basically including the cut in production in southern Brazil, which is substantial but not dramatic. It's certainly not sort of the worst case scenario, at least not yet. So for Rio Grande do Sul, we're at 20 million tons, which is down 10%, 2 million tons from where we were earlier in the year and where I think trend line would suggest. Now, if it continues, if the drought in Argentina and southern Brazil continues, that number could move lower. But given the yields that we're hearing out of Mato Grosso and Mato Grosso do Sul, it doesn't seem like whatever you take out, or almost whatever you take out of southern Brazil, will be enough to get that crop down below 150 million tons or so, which was around where expectations were. So Brazil will have plenty of soybeans to crush. And I also think that Argentina, while their crop this year is obviously hurt by the drought, and this is the third consecutive year that the crop has been impacted, Farmers tend to, again, sort of store soybeans as a hedge against economic uncertainty and inflation. And so as a country, they tend to carry higher stocks than other countries. The government, because they rely on exports for foreign reserves, has implemented 2 programs to get farmers to sell their soybeans. The first one was really successful. The second one, a little less successful. But the point of all of that is just to say that even with the U.S. out of the export market this year, and if we think about it in the longer term, don't suppose that the U.S. is coming back anytime soon. In the short term, Brazil can pick up, and Argentina probably has some stocks to offset the decline in their crop. And then in the longer term, as Argentina comes back, they probably will pick up the U.S. exports, which, if things work out the way that it seems like they're going to, the U.S. is going to overproduce meal, and a lot of that meal is going to need to go to the export market. That will depress meal prices, pressure the Argentine crush industry, and so having a greater demand for their soybean oil exports will help offset that a little bit. Now, I don't know whether it will be sufficient to really offset all of the revenue loss from meal. A lot of it will depend on sort of where crude basis ends up and how strong world demand is, whether things get resolved in Ukraine, that kind of stuff. But I think when it became apparent that the U.S. would need to exit the export market, that we would overproduce meal, one of the early conclusions was that the Argentine crush industry is going to come under a lot of pressure, and there's probably going to be some rationalization in capacity down there. That still may happen, but it looks like it's probably going to be a little bit less than at least I would have expected anyway. The change in USDA's crush and production forecast raised their prediction for the yield up to 11.77 pounds. I think I said last week or a couple of weeks ago that was the last time you would hear about yields. I think this probably will be the last time that you hear about yields. 11.77 is down about 0.05 pounds, I think, from last year's average, roughly 0.5 or 0.05 or 0.07. So even though they've come up quite a bit, we're still a little bit below last year, but not as bad as we all thought, sort of after we got the early, I think, November, the November yield, which looked really, really low. Outside of that, not much else here. I pulled this slide from USDA's monthly oil crops outlook report, which, if you don't know about this report, it's an excellent report. It comes out shortly after the WASDE every month and details a lot of the thinking behind USDA's balance sheets. But I thought that this was kind of an interesting chart because it shows world crush for all of the oil seeds and other things like palm oil and stuff like that. USDA cut their crush forecast by 2.9 million tons from January to February. That was all in world soybean crush, which was down 3.4 million. They actually raised their crush for sunflower and for canola. And what that kind of means, and what this chart kind of shows, the reason that I wanted to put this chart up there is if you compare even the reduced crush from January to February, so even if you compare February's crush to the last several years, you can see that there's a significant increase in the availability or in the volumes of oil seeds that are going to be crushed, and hence the availability of soybean oil. One of the things that I think could really help the market out or pushed the market higher than maybe it would have gone otherwise last year and the year before was that there was substantial demand for soybean oil because of problems with other crops. So last year we obviously had the drought in the northern plains in the U.S. and the prairies in Canada that cut canola production substantially. The year before that, there was a drought in Ukraine, and then this year, obviously, last year and this year, obviously, the war in Ukraine is also having an impact on the available supply of sunflower oil coming out of the Black Sea region. But despite that, there still is a significant increase in crushing volumes in 22-23. And so the world is relatively well supplied with soybean or with vegetable oil. And that shows up in Malaysian palm oil exports. It also makes it easier for the US to kind of back out of the export market, even in a year when the Argentine crop is going to be smaller than expected. And what this ultimately means is that if this theory that I have is true, that in the second half of the year, renewable diesel producers are probably going to need to produce more than the mandate suggests, and that will support feedstock prices. Well, this year you don't have the backdrop of the world is short vegetable oil, and so US feedstock is competing with other vegetable oil consumers, or US biofuel feedstock demand is competing with other vegetable oil importers for relatively limited supplies, even if they're not directly soybean oil to soybean oil, because a lot of what happens is, if the best example, again, I've said this a lot, is as we were coming out of the COVID lows, China was short sunflower oil because of a drought in Ukraine. They went and bought a bunch of soybean oil from Brazil. So it doesn't have to be sort of like for like substitution. The shortages in other vegetable oils can support soybean oil prices. Or if the world is well supplied with vegetable oil, then having prices move higher will probably be a little bit more difficult. And that's one of the main reasons why, even though I expect that that demand will be stronger than expected in the second half of the year, I don't think that we probably will get back up to test sort of those record levels from last year, because outside of the US, the competition for vegetable oils just isn't as dramatic this year as it has been in the last couple of years. On to canola, I think I wrote in last week's report that that USDA doesn't change its canola oil or its canola balance sheets that much in the February report, because they released the oil crops yearbook in March. And so what I was thinking was, well, they wait until the March WASDE and then they do all of that, and then they put it into the yearbook. But it of course makes more sense that they actually do it in February so that they can make sure everything's correct when they put it in the yearbook in March, and voila, here's what we have. So USDA reduced their canola oil production by 35 million pounds. They're still significantly above where we are, primarily because their crush is still well above where we are. They raised their imports to offset that, which left 168 million pounds of supply that needed to be offset by demand to keep stocks unchanged. And they did that, most of that. Biodiesel production, they're up to 1.7 billion pounds. Even though we're 200 million pounds below that, I don't really disagree with that number. I just don't know what the demand is going to look like. I have an idea of what I think it's going to be, but I've been relatively conservative in my approach to including canola oil in the feedstock mix. Now, canola oil is really competitive right now, so I think probably the first couple months of canola oil use, January, February, post the approval of the pathway for the renewable diesel RIN, will probably be a bit stronger than the long-term demand for canola oil. So we heard kind of anecdotal reports back in November that renewable diesel producers were buying canola in anticipation of the approval of the pathway. At that point, canola oil was about as competitive as it is now, maybe even a little bit more competitive than it is now. And so some of those purchases, I think, are, this is the way we're going to do business, and we're just kind of getting a head start. Prices are good right now. We're just kind of getting a head start on what we need to buy. Some of that business, I think, probably is going to be opportunistic. And so whatever the numbers are in sort of January and February, I probably will fade those a little bit going forward, and then we'll see what kind of March, April looks like. And after that, I think I'll probably feel like I have a pretty good handle on who's going to use canola oil and who's not. Of course, people say that they're going to use canola oil when they make their announcements, or some of the plants say that they're going to use canola oil when they make their announcements. So there's going to be some demand, and then there's places where it also makes sense, the West Coast refineries, it makes sense for those guys to use it, in any refinery that is in the northern third of the country, especially if it's kind of centrally located, or Montana is a good example of a region where canola probably is going to make a lot of sense. So there will be some natural demand, and then there will be some demand that depends on how competitive canola oil is. Again, canola oil is relatively competitive right now, and so I expect to raise that number. I just don't know how much I'm going to end up raising it. 1.7 billion seems reasonable, doesn't seem unreasonable, I guess, to me, but I'm going to wait to change my numbers until I feel like I've got a little bit better understanding of what the real market is going to look like. I'll change them after we get the January data from the EIA, but again, it probably will take me a little bit to really kind of feel like I've got that zeroed in. Outside of that, they also raised their non-bio usage, and they cut their exports. Now, 200 million pounds of U.S. canola oil exports isn't close to the same thing that 500 million pounds of soybean oil exports are. You can just see from the history it's down, but it's not sort of historically low like we've seen in soybean oil. The one of the big questions that I kind of have going forward is that if right now, I feel like the veg oil marketplace is saying we've got plenty of veg oil, you know, basis has been weaker than it was last year. And one of the things that we had anticipated was, as soybean oil use in renewable diesel production ramps up, that canola oil would fill in for soybean oil in the food industry in particular, but in non-biodiesel applications. And given the mandates, even with the idea that the renewable diesel producers will need to overproduce in the second half of the year, given the mandates, it doesn't seem like that's probably as much of a certainty as it felt like it was 6 months ago or a year ago. USDA's non-bio is only 150 million pounds above where we are. But I'm tending to believe that non-bio probably has a better chance of coming down than it does going up. It depends a little bit on how strong the economy will be. One of the slides that I meant to put in this week, and I forgot, and I'll do it probably next week, is the food at home and food away from home series. I updated that yesterday, and I was really surprised at how strong the 2023 demand looks relative to what I would have expected. And by strong, I mean, if I compare it to the 5-year average in constant dollars, what it looks like. And if you look at it monthly, there were monthly changes that were 10%, 12% up for food spending in constant dollars. So take away the inflation part, just food spending. And so if that's the case, then probably non-biofuel demand will be stronger than I expect for both soybean oil and canola oil. We're still relatively strong in non-bio in soybean oil, although a little bit lower than we had been. But I think the real question is, where is canola? And then that translates into imports from Canada. And you can see that we're significantly below where USDA is on canola oil imports from Canada. So this just shows domestic US use biofuel and non-biofuel. And you can see my expectation is that, okay, if it's not this year that that we need to sort of use a lot of canola oil to substitute for soybean oil, that it may be next year. Or maybe put a better way is, we've got pretty aggressive growth built into our non-biofuel forecasts going forward. And I think it's maybe just a matter of time before that non-bio use really does sort of start to take off. Now, again, some of that will depend on how competitive canola oil is with other oils. But if you assume that, like the world has been a couple of years ago, the US is going to be short sort of vegetable oils or available vegetable oil supplies, canola oil is kind of the perfect oil to fit in, because it works well in the food industry. And at least at this point, the demand for canola oil from biofuel production in Canada is not so strong that it's really cutting into their import or to their exports. So it's probably also going to be relatively available for that as well. Okay, so Canadian canola oil supply and demand, USDA did not make any changes at all to their forecast. The main differences really are between our two balance sheets are in exports and domestic usage. One of the things that I will say, this chart doesn't include it, but as part of the long-term report, we're expanding our that report in the balance sheets in that report to include Canada this quarter. And so in future tables, there will be a biofuel line, or there will be a biofuel line and then a biodiesel and renewable diesel lines that will detail the feedstock demand in Canada, or my expectations for the feedstock demand in Canada. I think that that right now, sort of that number that you see under domestic usage includes some expectation for a bit stronger use of canola oil in biofuel production domestically in Canada. But at this point, the analysis that I've done on that isn't hooked into this balance sheet. So don't take that that number is one that's probably not going to change, because it probably will change by the time that we get to the next WASDE report, really probably before the end of this week. I wanted to show this chart. So it's a little bit of a confusing chart, but it's essentially last year's exports and crush against this year's exports and crush. And I wanted to show it because I think, as I've sort of said before, the last couple of years, basically, I have kind of, if I'm going to make changes on the demand side of Canada's canola balance sheet, I was going to favor crushing. And so if I was going to increase supply, then I would probably add it to crushing. If I was going to decrease supply, I would probably take it away from exports. This year is a little bit different. And in fact, USDA raised their forecast for Canadian canola seed exports by, I think, 500,000 tons, which left it significantly above where I am. And you can see I've got a pretty sharp drop off in January and February, and then kind of bounce along at the typical seasonal pattern from there. And you do get a decrease generally in exports. It's natural. It follows the same pattern that basically every country that exports agricultural commodities follows, which is after harvest, you get big exports and then they slow down. And then in the last half of the year, a little bit less than half of the year, they kind of bump along at some level. I say all of that to say that this year, I think that while I probably still maybe slightly favor crush, it's not as strong as it has been in the past couple of years, as the export demand for canola has come back. I think I said before, if you looked at shipments to China for all of last year, which, okay, was a drought year, but if you look at the shipments for all of last year and the shipments in the first quarter of this year from Canada to China, those two numbers were roughly equal. So export demand has come back, and it may be that my export forecast is too low, and my crush forecast is a little too high. The first part about that, I think there's a real chance that my export forecast is too low and I'll need to raise that. The second part of that, I don't know that I'm going to cut my crush forecast that much. I think I'm at like 10.1 million tons, and that's a little bit below the record pace that we saw 2 years ago. As you can see, we're through the first half of the marketing year, we're down 67,000 tons a month, which is effectively almost nothing. So it doesn't make me believe that we're going to really decrease crush numbers a lot in Canada. And in particular, if US demand in the second half of the marketing year for vegetable oils is really strong, and canola oil again fits in well into the food industry, then crush probably is going to be at or above my forecast, and exports probably are going to be above my forecast, and US imports are probably going to be above my forecast. So as I say that, all of that sounds like, oh, well, I'm still really favor crush. But the thing is that I think the last 2 years, I kind of could count on exports being relatively weak. There was so much value in the crush relative to shipping seed overseas. Whereas this year, I'm just a little less certain about that, and wouldn't necessarily be surprised if exports were a little stronger. If they are, I can take some of that out of residual. There's not a lot of stocks to reduce. I haven't let my stocks grow that much, so there's not that much there. But I probably can reduce the residual a little bit and increase exports without having to reduce my crush, unless we just get blowout numbers in January and February. And then I probably will need to think long and hard about what I want the export number to be and what I want the crush number to be, or what I think they're going to be, whether there's just going to be a real fall off in exports at the end of the year that offset better than expected exports in January and February, or whether I need to cut my crush numbers down. Malaysian palm oil supply and demand, nobody really cares about what USDA says about Malaysian palm oil supply and demand. Everybody looks at the Malaysian Palm Oil Board report, but I put this up here because I wanted to be, I guess, kind of consistent. I'll run through the changes USDA made, and then I'll talk a little bit about the MPOB report. So obviously they increased their production by 200,000 tons. They're a little bit below us, but not enough. And I think there's enough uncertainty about production going forward that wouldn't really argue with that prediction. I think more importantly, if you look back over the last couple of years, you can see that we're up by 1 million tons almost from last year, and more than 1 million tons from 2 years ago. And so the question is then, does that increase in production and supply, is that just build stocks, or is there actual export demand for that? And USDA kind of offset their increase in production with exports, which is optimistic, but their export forecast still is below our export forecast. So even though they moved it up, I think that I think they could continue to increase it, but a bit of it will just depend on what exports look like going forward, obviously, but more importantly, probably what happens in India after March 31st, which, as far as I know, is still the time when they're going to switch back from the I think they called them courteous discounts or something, it was kind of a weird and funny word, courteous discounts on the import taxes for certain cooking oils that essentially favored soybean oil and sunflower oil at the expense of palm oil. And so after that, then we may get a return to a more normal kind of trade pattern with India out of Malaysia. And if that's the case, then I think those export numbers are probably pretty good. If it's not the case, then I think I'm probably going to end up cutting my export forecast at some point, and that will probably go to raise my ending stocks number. On the Malaysian Palm Oil Board report, in last week's report, I said the most important number out of that report, I think, is probably going to be production. Oops. And while ending stocks are always important, I think that production, because it's going to kind of tell us what's going to happen in the future for the rest of the season for production, is probably more important in this report. And so the numbers come out, and of course my ending stocks forecast was essentially, it was less than 1% away from where Malaysian Palm Oil Board estimated end of January stocks. But the way that I got there was really odd. I think I under forecast production, but offset that with the offsetting change in exports, and then imports were particularly strong in January. And I had just cut my import forecast because in December, imports were only, the MPOB estimated imports at like 40 or 45,000 tons. And so based on what we had seen for the first 4 months of the marketing year, I cut my forecast pretty significantly. I think I cut it down to like 500,000 tons. And of course, this month, then we get more than 100,000 tons of imports, and the MPOB went back and revised their import number for December, which almost never happens. I can't remember a time that they have revised their import number after the report, and especially by 20,000 tons or so, a significant revision. And so I had to go back and add back to my my Malaysian palm oil import forecast. Now, I think that one of the keys to the imports will be what happens in Indonesia with Indonesian policy and the domestic obligation system. So we've heard that there have been stories suggesting that the Indonesian government is going to change the ratio from 6 to 1. Essentially, you can export 6 times the amount of palm oil that you have to reserve for the domestic market. So for 6,000 tons of exports, you have to sell 1,000 tons into the domestic market. And we've heard that that might be as low as 2 to 1, which I think sets up a situation that's relatively close to when they just banned exports, where you're going to flood the domestic market with oil. That price will become disconnected from the world price, and that will encourage people to find creative ways to get to sell palm oil at the world price. I think one of those creative ways is to export it to Malaysia and then have Malaysia turn around and sell it. And so I think that depending on exactly what the Indonesian government does, that will determine Malaysian imports and exports. And that's the one sort of scenario that I can see where I would raise Malaysian imports and then also raise their exports to offset whatever increase I make in imports, because it's just kind of a pass-through almost. And that's kind of what we saw after the short-lived ban, I guess, or at least the changes that the Indonesian government made to try and keep the domestic market better supplied. So I think that you probably will see something similar. When they banned exports, they had some problems with government officials kind of taking advantage in exporting palm oil outside of the normal system. And so they came up with this domestic obligation system that I think works better than what they had in place before. But I still, again, I think if they take the ratio down to like 1 to 2 or 2 to 1 rather, that probably will disconnect the Indonesian domestic market from the world market and set up that same set of incentives to get palm oil out of Indonesia and sell it in the world market. And I put this up just to kind of show you where imports have been. Imports are not a huge thing really generally for Malaysian palm oil. They're 1 million tons or less of supply, which when you're producing 19 million tons is not that significant. But at the margin, it can be interesting, and especially given the fact that we kind of are right around this 2 million, 2.1 million sort of ending stocks, the expectations for ending stocks this year, and that tends to be sort of rally mode or prices moving lower. Then every little change makes a difference, and the import number I think will ultimately be a little bit more important. So you can see that over the past year that Malaysian imports from Indonesia are down slightly from the 5-year average, and after Indonesia makes another change to the domestic obligation program, then we'll watch very closely and see what that number looks like in the following months. And if we start to get a real tick up in that number, then I think I'll go ahead and start to make those changes in Malaysian imports and then Malaysian exports to offset. All right, on to expectations for this month's EMTS data. I've got to say the December data didn't really follow to the normal pattern. You can kind of see from 2021 that you get a relatively big spike in December, and that's typically been the case. But last year, December was just a little bit above, for biodiesel was just slightly above November, and not even the highest production of the year, which tends to me a little unusual. So while I want to talk about what's going on in January, I think overall, if you think about the historical seasonal pattern in biofuel production, where January and February are really low, and then November and December higher to kind of offset that. That's not the reason that it's done, but that's the way that it kind of ends up working out. I think you probably are going to get a little bit flatter production, both on biodiesel and renewable diesel going forward. Now, if we have to build RINs this next year, or if the industry builds RINs this next year, then I think it probably will be even a little bit flatter than you would expect, because if the RIN bank is huge, then companies shouldn't, in theory, be scrambling around trying to get RINs to meet their obligations at the end of the year, and that should keep those November and December production levels lower. All right. With that said, we do expect that biodiesel production in January probably was up pretty substantially from last year, despite the fact that that we had a 17-cent increase in the HOBO spread from December to January. But even with that, you can see December production was 145 million gallons, and so January at 108 sort of still fits that pattern of kind of reduced profitability. And the HOBO spread is really a very crude measure of profitability. If you look at our estimate of profitability for biodiesel in January and in the preceding months, really, you know that it's at the upper end of the historical range, almost no matter what feedstock you use. And so as a result, I think that expecting production to be relatively strong compared to last year probably makes sense. Now, that said, you know, there were some weather issues in December that may have prevented facilities from getting all the feedstocks that they needed for January production, but they also had time in January to kind of catch up. So I don't know that that's going to have a big impact. Whatever we produce in January, I think again the question still is, what do we produce from sort of July forward, and will there be sufficient feedstocks to meet that demand, or will it be that feedstock prices need to rise enough and RIN prices need to fall enough and profitability needs to fall enough to start to rationalize the biodiesel capacity? For biodiesel, or for renewable diesel rather, this is just the capacity expansion story, obviously, as it has been. And so you can see we expect production to be up from last year pretty substantially, although not as high as December. And again, for renewable diesel, not only was December not higher than November, it was actually significantly lower than November. So ultimately, I think that renewable diesel probably is not going to hold to the same seasonal pattern that we've seen in biodiesel. If you look at 2021, you kind of see that it held to that pattern, and the pattern is still strong enough that when I spread out my annual forecast, it essentially gives me this pattern, which favors renewable diesel production towards the end of the year. And while I think this year it will be stronger in the second half of the year, I don't know, again, that that you won't see the last quarter production forecasts flatten as we go through the year, especially if we get production early in the year that is higher and kind of conforms to where capacity utilization has been recently. So in 2022, if you looked at it, capacity utilization kind of fell towards the end of the year and then is kind of leveled out. And so it may be that as we add more plants, that's just kind of going to be the capacity utilization, and then production will just become a function of when new plants open. They run at that capacity, basically all year. And so you get kind of a flattish outlook for production. Of course, month to month production will depend in part on profitability. But for renewable diesel producers, I think because one, the plants are generally larger, two, they generally have solid financial backing, that they will tend to run more based on capacity utilization than they will on profitability. Profitability obviously will always trump everything else. If profitability really goes down the tubes, then they'll slow down. But let's assume that that they are going to make decent profits, even if they're not as strong as they were a year ago. Then I would assume that this chart will sort of get flatter as we go forward. All right, final chart. So this is my estimate of the gap between the ethanol mandate and anticipated ethanol production, which as of 2022 became something that was important to understand because it effectively is another area where biomass-based diesel can produce over relative to the biomass-based diesel mandate because of the nesting feature of RINs, and because D4 RINs are worth more than D6 RINs. It also kind of shows why, I think, at least partially why the spread between the D4 and the D6 RIN is so narrow this year. Now, the one thing that I will say is that our forecast for production this year is 14 billion gallons. That's down about 300 million gallons from last year. I think it's reasonable to argue that production should be equal to, or maybe even a little bit higher than last year, just depending on the economics of ethanol going forward. And so if you added 300 million gallons back to production, that would reduce the ethanol gap this year down to 900 million-ish, which is basically in line with last year. Now, the RIN market is not telling you that that's what it expects at all. If anything, I would say the RIN market suggests that the 1.2 billion gallon shortfall is probably too small, and that it may be bigger. And the one way that I could see that happening is if you start to get the diversion of ethanol facilities to SAF production. There have been commitments by some of the really big crushers that they're going to take a substantial portion of their ethanol capacity and turn it into and use it to produce SAF. And that breakdown or the split between SAF production from renewable diesel and SAF production from ethanol is going to be one of the key things to understand over the next several years, because as SAF grows, however that sort of die is set over the next year or two, it's going to determine a lot about what SAF production looks like when it goes from being 10 million gallons a year to 2 billion or 3 billion gallons a year. And I think that if SAF production is substantially more profitable than ethanol production, that you probably will get ethanol production just at the bare minimal level needed for octane boosting in gasoline, and probably not much more than that. And if that happens, then it's just a question of figuring out how much ethanol do we actually need, and how much ethanol capacity can produce SAF versus how much renewable diesel capacity do we need to produce SAF. From a renewable diesel producer's perspective, from both perspectives actually, the drive to EVs is going to make it so that, in theory, although this will never really be true, But in theory, we won't need renewable diesel or ethanol at some point in the future. And so finding something to do with your plant once they don't need the product that you set it up to produce is going to be key. And SAF is kind of that long-term answer. And so I would expect that that both industries will probably try to get pretty aggressive about establishing a foothold in the SAF market over the next couple of years, because of that long-term, the need for long-term survivability, because the market's wide open right now, and because both can produce. And so I think that again, what happens in the next couple of years will tell us a lot about, again, what that production looks like when it's 2 billion gallons or 3 billion gallons. I think the economics of production on paper can change from when you actually go to implement, and as a result, whatever I think about that split right now probably will change as we start to increase SAF production and we start to find out, oh, well, it's a little bit harder for ethanol plants to convert, or renewable diesel facilities have a little bit more difficult time with pretreatment with SAF, or whatever it is. I'm just saying, I'm not trying to say one or the other, just trying to say that there probably will be problems that will make whatever the split is look a little bit different than if you just sit down today with a notebook and kind of write down the economics of SAF production from ethanol and write down the economics of SAF production from renewable diesel. Either way, what I think is that even if we do produce 14.3 billion gallons of ethanol this year and the ethanol gap shrinks, it's still a pretty substantial gap. And as a result, while the spread between D4 and D6 may widen a little bit, it's probably not going to get back out to the sort of 30 cents or so that we saw last year. Now that I've said that, it'll go there in a couple of weeks. But all right, that is the end of this week's presentation. And so somebody has been kind enough to ask a question. Hi, Tori, what is your estimated percent contributions of WDG soy versus RBD soy to renewable diesel production in 2023? And where did it end up in 2022? It's hard to know exactly where it ended up in 2022 because USDA doesn't include co-processing in their renewable feedstocks number. They actually include co-processing in their non-biofuel number. So we don't have a number to really kind of say, okay, well, this is how much soybean oil was used one way or the other, refined or less refined, I suppose is the way to correctly put it. So it becomes a little bit harder to give the split. This is what I would say. One, I'm happy to, if you write me an email, I'm happy to kind of get back together with you and talk about this in a little bit more detail, but I'll, without pulling up a bunch of spreadsheets and all of that, it's going to be hard for me to give you an exact number for 2022 or for 2023. What I will say is that the vast majority of renewable diesel facilities at least have announced or do have pre-treatment capacity. And as a result, I think that going forward, what you're going to see is that most of the renewable diesel demand is for crude or some level of crude degummed soybean oil or unrefined or less refined feedstocks more generally. And only a very small portion of it will be for RBD or RB soybean oil. And as a result, while we've seen sort of the exact opposite over the last 6 weeks or so, if you think about RVD basis as the combination of crude basis plus a refining margin, if all of that demand switches, or a substantial portion of that renewable diesel demand switches, or doesn't even switch, it was just that we all expected it to be RVD demand, and now it looks like a lot of it's going to be crude demand, or again, less refined demand. Then what probably happens is the crude basis goes up, the refining margin goes down, but RVD basis doesn't really change that much. Maybe it comes down a little bit. I think we really will. I think so far it's still just a little bit too early for this effect to be impacting basis levels. I'm going to say that partly maybe because I've been so completely wrong on this so far over the past 6 weeks that sounds like a good excuse. But I think by the time we get to the second half of this year, we probably will we will start to see that happen. And I say that for two reasons. One, because we're going to add more renewable diesel capacity. Not that we don't have a lot of renewable diesel capacity already, but two, a lot of the renewable diesel capacity that we have right now is relatively new renewable diesel capacity. And anecdotally, and more famously, I think last year or 2 years ago at this point, there have been renewable diesel producers that have had difficulties getting their pretreatment up and running consistently. And so when that happens, then they have to buy RVD. And when they start up, they buy RVD or RV to get the plants going, so that they know that they have a consistent supply at the beginning as they're working their way up the learning curve on the pretreatment. And so I think the bottom line is whatever the actual answer is for 2022 and whatever 2023 is going to be, I think 2024 and beyond is going to look a lot different than these last 2 years. Now, the one thing that I just thought of that I haven't really looked that deeply into is how does refining the feedstock at the plant, at the renewable diesel producer's facility, does that have an impact on CI scores? And I honestly don't know that it does or that it doesn't. But I say it because if after the blender's tax credit expires and we go to an LCFS-like credit for the whole nation, the IRA credits, then if pretreatment does have an impact on CI scores, then that's something else to consider about where that sort of split will end up. Let's just say, for example, for whatever reason, and I don't know a good reason why it would, but let's just say, for example, that pretreatment adds 15 points, something ridiculous, to your CI score. Then you probably, depending on the exact economics, you probably are going to do less pretreatment or pre-treat feedstocks that don't have a big impact on your CI score. And if there are feedstocks that for whatever reason do have a big impact on your CI score for pretreatment, you're going to buy those refined or at your spec, so you don't do it. Again, I don't know that is going to happen, or I don't know that pretreatment has any impact on the CI score. But that's something that I think would be interesting to figure out. And I actually know some people that probably can help me figure that out. And so if I find out anything interesting, I will let you know. But write me and we can talk about this in more detail. What is the minimum spread between RB, RBD versus crude to make the pre-treatment business case attractive? Excuse me. It will depend a bit on plant size, and I don't know the exact number, just to be really frank and honest about it. What I do know is that when the refining margin was bouncing around 7, 8, 9, I think even 10 cents, you didn't see a lot of renewable diesel producers that were planning on using pre-treatment, or at least that was my perception of what happened. And then when the refining margin blew out to 20 cents, then all of a sudden everybody was going to do pre-treatment. So I would say it's somewhere above 10 cents, but again, somebody will know that answer much better than I will. And again, if you'll write me an email, we'll set up a meeting and we can talk about this in more detail. And you have to give me a week or so to kind of track down some people and ask these questions and figure them out. But I promise you I will. All right. With that, that is the end of this week's webinar. As always, thank you so very much for attending, and I hope to see you back here next week. I hope everybody has a wonderful Valentine's Day with your significant other. All right, see everybody next week.